Welcome to Build a Business Worth Buying, the podcast where seasoned entrepreneurs, M&A experts, and world-class operators share behind-the-scenes stories of building, scaling, and selling remarkable businesses. I'm your host, Aaron Alpeter, and every week I sit down with people shaping the world of acquisitions, founders who've cashed out, buyers with bold strategies, and advisors who help make deals happen. This is not a podcast for beginners. It's for those who know the grind and want actionable insights to make their next big move. Get ready to take notes, rethink your strategy, and hear untold stories of what it takes to build a business worth buying. Well, welcome everyone. I hope that you are doing the best you can with all the tariff craziness that's going on. We've got a great episode today. I've got my friend Kunal Thakkar. He is a seasoned leader in global supply chain. He's got over 2 decades of experience in lots of different industries. In December of 2022, he was the Chief Supply Chain Officer for Thrasio, and he brings really extensive experience into the next generation of consumer goods company. Prior to Thrasio, Kunal served as the Chief Operations Officer at First Leaf, which is a personalized wine subscription service. He was responsible for global sourcing, procurement, production planning, and lots of other stuff that was there. Prior to that, he's been the head of Walmart's international global e-commerce business, the head of global operations at Newegg, and he continues to serve as a strategic advisor for several companies in the supply chain technology space. I'm really excited to have Kunal on today. He's widely recognized as someone who's able to seamlessly manage the current demands, which there are a lot of demands today going on. He's got a really good knack for coming up with strategies, thinking through digital transformations and things like that. So today we're going to talk a little bit about the due diligence process, something that he knows quite a bit about. Kunal, welcome to the program. Thank you for being on.
Thanks, Aaron. I appreciate it. And thanks for the invitation to be on your podcast here. Really excited for our fun conversation.
Absolutely. So let's dive right in. You've been involved with M&A due diligence at scale through all of your businesses that you've been a part of. Can you share a little bit about your background and your experience evaluating businesses for acquisition?
Sure, happy to. So, Aaron, as you entailed earlier, I've spent years in global operations leading the end-to-end supply chains for companies ranging from startups to Fortune 500s. The journey has definitely given me a front row seat to see how businesses really operate under pressure across borders and at scale. Led operational due diligence for multiple acquisitions, focusing on core areas like logistics strengths, supplier resilience, and ability to scale. Technically, my approach has always been more a blend of the real world, boots on the ground expertise with structured framework, but mainly digging into everything from supplier dependencies to fulfillment economics, and obviously the post purchase customer experience.
How would actually go into these deals? I mean, how would you assess the strength of a supply chain, for example?
Yeah, I think there's a few areas that I'd lock into when it comes to that from upstream through downstream, and a lot of times it starts with the manufacturing and the supplier details, right? Does the company have a proper ownership of IP or intellectual property or manufacturing rights? Is very critical as a differentiator. If a brand relies on one supplier versus multiple suppliers, is there a proper contractual term or protection? If not, then that's a red flag. For example, if we have a vertically integrated company we are considering that does manufacturing with their sister company, which is great, it sounds good, but until if there is no formal agreement or worse, there is no IP protection, then that can be a problem in the future state. So we keep an eye on that. So that's one. Logistics flexibility and maturity is the other thing to make sure that a company has certain hybrid models, whether they are serving through FBA or 3PL or both. If it's omni-channel, that they do a little bit more of the due diligence to understand how inventory is allocated, how it's being managed, documentation as well in that perspective. Margin pressure. And if we are seeing a brand's landed cost has been steadily increasing and there's no clear path that, hey, if we were to come into play, bring in the economics of scale, we still can't make much changes through supplier negotiations or product innovation and packaging innovation, then that's another area that we'd evaluate closely or be cautious about. Inventory accuracy for me is big. Issues like incorrect SKUs or SKU mismatch or aging inventory that's just collecting holding cost, and that can become a very common deal breaker. And last but not the least, what are the type of skew characteristics are we talking about, right? Are they oversized, awkwardly shaped? We don't think about that upfront, but later on, this can become a friction point if it's overlooked, especially if it's going to add a lot of last mile cost and there's not much we can do about it. So those are some at a high level that would be within the supply chain scope that we do in terms of due diligence.
That's in your experience. Have you seen a supply chain that had enough red flags that someone walked away from the deal, or was it something where the marketing message or the revenue or the growth was so interesting that they ended up doing the deal, but they paid a much lower multiple? Which way does it typically fall?
I think with the past, as we know, there's ton of opportunities out there in the market. So if there were a few red flags that we felt that, hey, listen, this was not worth getting into, then we'd at that point of time walk away and go into the next model. Unless it's like, hey, it's a super differentiator and there's nobody else in the market with that. But typically it's the latter where we'd walk away. At least that's what I've done in my past experience in terms of providing guidance or providing my input as part of the operations leadership to say, hey, on the operational front, we can't build much value, or there is an issue with compliance or HTSC codes, and this is something that's a no-no, and that recommend we walk away from an a supply chain or operations perspective.
Gotcha. With that list you went through, are there any deal killers, right? So you mentioned inventory accuracy. If you're looking at this and they've got 10% inventory accuracy, is that an absolute deal killer for you? Or is that something that's like, okay, that's a red flag, we're gonna have to work through it?
Yeah, no, I think weak inventory controls are definitely a red flag to walk away sometimes because it can make or break a business, or that could be cash flow issues in the future if you do not have a proper control of it. Other things would be lack of product innovation, or a pipeline doesn't exist to develop new products with variation. That, hey, everything sits in the founder's head, and once you acquire that company, all that is gone, and you're sitting with a product that is not competitive at all, and it's now a price war again. If the SOPs are not documented correctly, again, same reason. If it's a founder-led business, there is nobody who's going to be able to help you transition from there. That's definitely another key area to walk away. Poor account health, whether it's on Amazon or Walmart or others. I think if this is a heavy FBA business, that you want to make sure that the account health on Amazon is good. And obviously, last but not the least, but inconsistency or manipulated sales or cost COGS reporting is another area where we'd say, hey, listen, we'd respectfully pass it and gracefully walk away from it.
How would you validate that the COGS have been misrepresented? Or you would basically ask for some invoices and start to go through it and then be able to say, like, hey, 2 plus 8 doesn't equal 4?
Yeah, I think there's two portions to this. One is obviously proper due diligence and analytics and understanding with the finance team, obviously, to make sure that we are evaluating business in the last 6 months, year, 2 years, whatnot, to see if and if it's making sense, right? COGS being obviously as cost of goods sold, what's the manufacturing cost, what's the first mile freight cost, what's the customs compliance or duties, etc., to form the COGS. But secondly, also benchmarks, right? I mean, we do have in general in any business, you have your own supply chain network, preferred partners, etc., for you to understand, hey, if the COGS are becoming a X percentage of the total gross sales, or the freight or last mile is Y percentage, things like that would allow you as an expert to use your experience and judgment, or reach out to your other logistics partners within the network to verify or do the due diligence on it.
That's helpful. Speaking of due diligence, I find that a lot of times when I talk to founders that haven't been through an exit before, there is this reverence around due diligence, like, oh, this big thing that we have to go through. And I try to tell them, no, you're not necessarily telling a story. You're explaining your business. You're walking through. They're getting an intimate look at it. And I'm curious to know what kind of due diligence actually matters for an acquirer. And so maybe we just start off, like, what are some misconceptions that you've seen sellers have about due diligence, and what would you tell them in order to prepare better?
Yeah, so I think one of the things that we to note is that it's not always about the financial due diligence. A lot of sellers think that it's all about the financials, but no. I mean, operational due diligence can make or break the deal. An EBITDA might look strong, But if your supply chain is fragile, example, if you're dealing with hazmat SKUs or you're dealing with things that are not in compliance and not processes are not documented correctly, or there are lack of permits, or if there are customized systems that cannot scale, these are major red flags. I mean, we'd go through, as I'd mentioned earlier, right, upstream to downstream, whether it's looking at the people that were managing it, the processes, the systems, what's the scalability, what's the partner network looks like, would look into all those. So, buyers will either price that risk in or walk away entirely from a deal.
Yeah. Yeah, I had a conversation the other day with someone who was um, talking about the exit that they had gone through. They weren't the founder, but they had gone through the acquisition, and they talked about how they were doing the interview with the acquirer, and they had all sorts of operational issues. Kind of one big thing was there was no quality controls in place. They leveraged their manufacturer, but they didn't have an internal quality function or thought for that. And they said, the deal went through. There wasn't enough of a roadblock, but they were talking afterward, and they were saying like, what did you guys think about us? They said, yeah, your supply chain was an absolute mess, and it wasn't anything we couldn't fix, but we would have paid a lot more for your business had you been in a better position.
Indeed. No, I think that makes a lot of sense because, see, there are certain things that can be fixed post acquisition because whoever is acquiring definitely has a stronger, not necessarily a better, but always a very broad network of business partners that they're working with. So that allows you to bring in either brand optimization on the front end to grow the business, or on the supply chain side is the supply chain optimization on the back end. And it allows you to bring that economics of scale. It allows you to streamline the operations with the right process and systems. So there are some things that are fixable that I would say the sellers should not worry about, and there are some that we discussed earlier is a no, a red flag that there's a high chance somebody will walk away if the supply chain is in a mess.
Yeah. What are some of the fixable issues that may seem like a big problem at the time or to a founder that sellers actually aren't that concerned about?
So I'd say starting with supply chain costs, because that's the first thing we'd look into when you acquire. So that, hey, how can I bring the bottom line to a point where it's bringing in better margins, is more profitable? So I think with scale and stronger partners, that's often the area we look into. So supply chain costs is something that we would take care of on the back end. Because when you are dealing with a transportation partner with 5,000 packages a month versus you tie up in the broader network with the person or the company that's acquiring you, then now you're talking about 50,000 packages a month or 15,000 packages a month. That gives you the better volume or the discount tiers, right? So just an example. 3PL and warehousing headaches. There are some 3PLs that are fantastic operationally, great for omni-channel partnerships. But there are others where you may have an issue in terms of a timely response or inaccurate inventory count, etc. Those are solvable. I mean, when you acquire a company, you are probably going to shift that business into your own operations, if not owned by you, then a third party in the preferred network. Lack of sophisticated supply chain systems, like if you do not have like the state of the art OMS, WMS, TMS, it's okay. As far as the data is clean, the systems can be added or overlaid. And then last but not the least, is important, is the stock outs, right? A lot of times you feel that, hey, there is a stock out and you losing on sales, but that becomes an opportunity where, with accurate forecasting, right tools, balanced supply demand, and planning, that issue can be resolved to overcome the limitations.
Yeah, I think the last part you mentioned there about stockouts being an opportunity makes a lot of sense because the reason why someone is going to buy a business is because they think they can do more with it, right? And so they don't want to buy it for what it is; they want to buy it for what it can be. And so if you've been out of stock for 2 months and you can fix the supply chain and improve your sales by a sixth just by being in stock, like that almost becomes a bit of a plus in that column as it goes through.
Yeah, and I think that's you absolutely right, Aaron, because think about it that the the thought process of acquisition is that, hey, is this business A going to add value to the existing portfolio? Does it give us the proper diversity, or does it add on to the existing expertise we have, right? Whether it's growing the top line by going on to Amazon or going into Walmart or other marketplaces, and or going international and selling on other marketplaces internationally, or into brick and mortar, right? on the top line. On the bottom line, and not all companies that are doing business that you are looking at acquiring have that presence, whether it's the limitation that they've got to a ceiling where they can't exceed that, or they don't have the experience, that they're done with the business and they're like, hey, listen, I've grown to the point I could. I'm happy if I get X multiple for it. And on the bottom line, whether you think about leveraging a manufacturing or a sourcing platform or a supplier network in Asia where you can get economics of scale, or a proper transportation partner for the first mile, middle mile, last mile, returns management, or a fulfillment facility that's your own, or a 3PL with the right technology, automation, etc., that can bring in a better post-purchase customer experience. I think those are all the things that you would add value when you're acquiring a business to improve the top line and the bottom line, and ultimately scale the business, because you are acquiring it to add value to it, and you know exactly what your strengths are in that flywheel.
Yeah. I think that's a really good synopsis of the thought process behind an acquirer. Uh, some of the folks who may be listening may be a first-time acquirer, right? They may look at it, and so I'm curious, like, how do you stay disciplined in that? Because sometimes people can fall in love with a deal and they stop becoming objective about it, and then they end up doing something they shouldn't end up doing. And so I'm just like, as an acquirer, how do you look at something and still feel good enough about a deal that you want to do it, but not so much in love with it that you're going to do it at any cost?
Yeah, I think few things I would say on that aspect is, say 5 areas of focus on an operational standpoint. One is, hey, do you have the right sourcing agility,
Mm,
right? In terms of brands that have dual sourcing, proper contracts in place, and the ability to shift production regions. Example, in this situation, say if China's got high tariffs, can I shift it swiftly to India, and be more resilient about it? That's one area that companies that are out there, to sell or to be acquired, should think through. The fulfillment maturity we mentioned earlier about, right? That's important. The tech stack, I think having real-time visibility into inventory and the order flow is essential. Uh, Proper financial accounting systems, again, play a big role. Team and talent, is there a proper operational leader post acquisition to help through the transition? Is a huge plus, right? If it's the founder who's still doing everything, that's risky. Last but not the least, global presence, right? Are you in multiple channels? Are you, do your packaging meet the international standards? That those show high potential, in my opinion, where it's like, hey, if you had a few of or all of these areas on an operational perspective or standpoint, yes, it's a great lead, or potential. But if there is one or two of these that did not exist, it's not that the buyer is going to walk away, but definitely a lower incentive for the buyer to get into the play.
yeah, they become a little bit more apathetic of we could do it, we cannot do it. Yeah,
Yeah, yeah,
whatever.
yeah. So, and again, different companies have different strengths, right? When they're acquiring, I mean, some may be like, hey, I manufacture my own product and I take this acquisition, I could just plug in the entire manufacturing, and overnight I have the benefit of the margin and the quality and sustainability standards. All those are very critical in supply chain and operations. On the other side, it could be I have amazing contracts with the FedExes and the Ontracks, or the DHLs of the world, and I can take this to the next level right away through my discount tiers. Those would be easy, no brainers, versus a company which is buying has zero presence in brick and mortar, might start to think that, hey, is this product something that I can continue to scale only on online? And if I were to go omni-channel, do I have the ability to do it? And if not, and if these folks don't have the right skill sets, then I'm not going to get into it.
Yeah. Another way that I've seen this play out too is a lot of times, when you buy a company, you are investing more than just money, right? There's a certain amount of leadership attention, internal resources that are going to go to integrating and digesting that acquisition. And so there's a piece here where kind of what I hear you saying is if it looks like it's a company that can continue to be successful on its own and it can stand on its own 2 feet to some extent, then those sorts of things really add up in the plus column. Whereas if it's something that's a bit of a dumpster fire, and you're like, all right, I'm going to have to take my best people from my core business just to stabilize or turn this thing around. Even though I think there's potential there, what's the opportunity cost of working on the other things there? And so it's a bit of a tension, what I'm hearing you talk about.
It is, and it also depends on one other factor here is that, hey, how many companies are you acquiring, right? If you're acquiring
Sure.
one company, yes, you can put in your best talent and, from operations and technology and finance, and you can be in the bunker and make it happen, and you can get that transition seamless. But if you're thinking about multiple companies that you're dealing with or acquiring from time to time, those are some factors that you'd have to think of because then you are adding on more labor, you're adding on more time, and time is money.
Yeah, that's a great point there. I mean, do you find that there's like a recommended number of companies that people should acquire in a given year, right? Because I imagine if you're acquiring 200 companies a year, you've got to be much more of a plug and play. You can't really put a whole bunch of extra effort on there. Whereas if you are saying I'm going to acquire one or two, you're going to approach that differently. So I guess maybe the question is how do you approach acquisitions in that mindset, knowing that it has to be a plug and play versus you're going to be able to smooth some of the rough edges out?
Yeah, and I'm going to share this with purely my opinion, right? Because every company is in a different size. I say every lock has a different key. And with that being said, some companies have a very solid business model as an aggregator or have a solid playbook that they can seam and they have the right process, systems, people in place, and things will flow naturally. And some companies are doing this for the first time or just do a few a year. I'd say, give having enough in the pipeline is very critical to continue doing due diligence for multiple companies at the same time. But in terms of transitioning them into your core operations, if you will, or flywheel, I would say one a quarter is more sensible. In that too, if you're aggressive, right? Because um, there are companies that will acquire um, 20s or 50s or 100 companies in a year, but I think at the same time, you got to be mindful in terms of how is that impacting the service, the cost, the capacity for the business you're acquiring and your own business operations because you do not want to compromise on the existing business that's flowing for you.
Yeah, yeah. There's a lot there for sure. Um, yeah. Wow. Kind of continuing with the due diligence piece here. I'll tell you a story. I was talking to a founder, and they were talking about how they were getting ready to go through the sales process, and they wanted to make sure everything was just right. And so they ended up hiring a graphic designer and spent $20,000 building a deck. And they're like, it's got these beautiful graphics, and it's there, and the message and the things there. And they felt that having a really nice deck that could be sent around um, or they could go through was going to make the difference between someone being interested and someone not being interested. And they ended up selling their company, so it ended up working out well. But I remember thinking about this and thinking, you know, I don't know if that was the best use of time or money. And so I'm wondering from your perspective, if there are some things that sellers often really stress about or worry about as part of the due diligence process that really don't actually matter all that much to acquirers.
Yeah. No, I think that's a great question. And, sellers do tend to over-index on certain things, I feel. I think one of the critical areas is obviously the presentation and the deck has to be very simple and should flow well. I mean, that's important.
Yeah.
It should have as much as detail in the back data room you can, especially on the financials, right? Those things are critical. But there are certain things like, hey, do I have the best logistics infrastructure? Unless it's a true moat, an asset light is usually a better way to go when you're acquiring. Perfect looking fulfillment and transportation setups. No, I mean those things are often folded into the preferred partner network anyways. I would say excessive dashboards with no insights. If the data isn't driving right decisions and then just noise, I mean, we follow the DICA model that said, hey, you have the data, what information it is giving you, what knowledge can I get from it, and what action can I take from it. As far as you have that, no fancy dashboards are needed. As far as you have the clean data to work upon. So I would say, yes, definitely certain things get very over-indexed to think that everything should look perfect start to finish. But no, I mean, as far as there is core momentum in the brand, the business has great ratings, and they've built a good business and they're continuing to innovate and there's new product development happening. it's actually that's the core of the business. The rest all can be managed.
Yeah. As you talked about, maybe the dashboards, the fancy dashboards, not really mattering as much. Do you think there's value in a company even pursuing those to begin with, or is it something that, hey, this isn't building enterprise value, so whether or not you're going to sell or you're not going to sell, you've been acquired or are going to be acquired, like don't end up spending a whole lot of time on that.
Yeah, I think it's the core basic, the fundamental is needed, right? Otherwise, how are you running the day-to-day business to make sure that, your KPIs, your OKRs are in place, you have the right reporting structure, dashboards that simplify things that allow you to evaluate a week over week or a month over month number, right? Whether it's on the top line or on the bottom line in terms of cost optimization. I think those are important to run the business. So yes, keep those, right? Don't get rid of those, but trying to just add too many dashboards, too many OKRs that are not meaningful is what I would vary, sellers from, or ask them to say, hey, don't invest too much time in it unless it's really adding value to grow the business or to optimize the business.
Yeah, that's helpful. When it comes to operational complexity, I think I've heard kind of two schools of thought. One would be we want complex businesses because that means that there's fat that we can trim, and so there's peace there. The other end of it is like, hey, we don't know where all the bodies are buried, and like we just can't deal with this unwieldy thing. How do acquirers evaluate operational complexity? I guess what do they look for that determines if something is complex or too complex, and then how do they determine if it's worth digging into?
Yeah, I think as I mentioned earlier, if the top line is moving forward, right? Well, if you've built a strong brand, good reviews, loyal customer base, the back end definitely can be streamlined. But in terms of operational efficiencies, the only challenge comes to where if you're hiding something and if there is something deeper, like so
Hmm.
higher return rates that float around towards the end to understand that, oh my goodness, the return rates due to quality or product or whatever it might be super high. Sales might look good, but the returns are terrible. And or if there is aged inventory sitting that you are not aware of, that's collecting a high holding cost in the 3PL and collecting dust. I think those are things that you'd worry about. Um, if you go back upstream and say, hey, if the demand forecasting was not done correctly, and you're sitting on 4, 5, 6 years of inventory for certain SKUs, and do the logical math on it to say, hey, if I were to dispose this inventory right now and get a proper certification for it that was disposed without jeopardizing the brand, I'm better off 2 years down the line buying the same inventory again versus spending 5 years of holding costs on that at the run rate it is, even after trying all the promotional activities I could to price it right and try to sell it, right?
Yeah.
So I think those are some basic due diligence we would do when we say look at the inventory numbers, right? What's the run rate? What's the on-hand inventory? What's the lead time? What's the safety stock? Right? That's very good. SKU rationalization is critical when you do the due diligence. That's important outside of things we already spoke about, whether it's supplier network, transportation, fulfillment, infrastructure, or maturity, I think inventory, cash, working capital, cash on hand, these are important elements that will make or break or make a acquisition successful.
Hmm. You know, one of the things that I've seen is that sometimes there are founders that just love being a founder, right? Their business is who they are, and they will start to put conditions on a deal, right? They say like, oh, you got to keep all my people, you can't move this factory. We want to be able to support these charities, things like that. When you're evaluating a business, how much are those conditions like, yeah, yeah, okay, versus things that are actually disincentivizing you from going deeper, maybe because it's a bit of a canary in the coal mine to how the
Yeah.
rest of the business was operated.
Yeah, so this is a good question. I'll tie this up to the previous question because I think it'll be very relevant here. Is that bottom line, when you are doing the due diligence for a business, you are doing the upstream to downstream analysis of the current process. So I want to make sure that, hey, there is synchronization when it comes to the flow of information, funds, and goods, start to finish, right? We are looking at how things are flowing. What's the, whom are you relying on in terms of a supplier, business partner, etc. What is the current process? Is there any optimization I can bring in it? Can systems do some digital transformation for me to improve productivity, accuracy, throughput, improve my bottom line, improve my customer experience, right? And within that, if there are areas where the founder member is suggesting that, hey, we got to stick to this, or this is what I rely on, and if it's foolproof and if there is a contingency plan to that, then sure, let's incorporate that. It's not going to hamper the ability for us to improvise the business on top line or bottom line. But if it is going to come in the way of saying, hey, I am only going to rely on this particular sister concern company for my manufacturing, I'm only going to buy from here, right? Then that's a red flag. And then at that point of time, we have to make a conscious decision that, hey, I'm cautious about it. I do not want to get into something that's going to complicate my existing supply chain, right? Because you are bringing in the benefit and the value by incorporating this into your core systems, not by trying to create separate supply chain systems for every company you acquire. That's a no-no.
Yeah. Yeah, I can imagine how difficult that could be. I think part of this too is that if a founder has personified the business that they're selling and they feel like they're selling a bit of their soul, right, to go through this acquisition, there's a mismatch, right? Because the acquirer is looking at this as a financial asset, like an instrument or things like that. And so I think that there's an element here where there needs to be a little bit of separation mentally between the founder and the business that they're selling in order to make sure that there's uh, proper perspective. I guess what advice do you have about a founder who is going through the sales process? I mean, this is their baby, right? This is what they worked on for years. How do they have the right level of distance, but still don't come across in the sense of that they don't care what happens to the business?
I think so. First thing is the mindset, right? Is what is the reason that the founder is wanting to take the step of being acquired, right? Or getting merged into a larger organization or another company. I would say with full due respect to founders, because obviously, they have the ideation, they've developed something and they're selling something and they've done good for themselves and it's a successful business. So kudos, because not everybody is able to do that. So full respect to that. But at the same time, when you have a mindset that, hey, I'm ready to hand this over to somebody to get the true potential of it. At the end of the day, you're taking the business to the next level because either you had certain limitations and financial crunch, or you had limitations in terms of expertise, or you're just done and you're like, hey, I'm happy with whatever multiples I get and then I will do something different, which is all good. In that scenario, the only advice is that, hey, listen, have everything properly documented so that way is transferable, there is a proper transition, and at the end of the day, that will do justice to the business, that will do justice to whoever is acquiring it, and ultimately to the product or the idea, right? So keeping that safe balance, that if the acquiring company wants you to continue for X amount of time to either make sure the transition is done right or to help continue do the product development and innovation, which is very, very important, right? I think be open to that idea. And if there is a different path that the acquiring company chooses for the founder after paying them, or after confirming the details of the deal, then be respectful to that. And once you've done gracefully the documentation and the handover, be available for a certain time as a consultant, and be graceful about it, or have everything clearly in the documents to be able to walk away from it, and then let the other company take it to the next level. And it's such a fine line, right? Because think about it, if you and I were to innovate something and develop a business, it's not easy. It's your baby. You've grown it, right? But thinking about with the mindset that, hey, if anything is going to get bigger and better from here, to see your products across the world online and on offline channels, I think that's a big thing also. Plus, you got the worth of it, in terms of the hard work and the efforts that was invested in it. Those are things to think through.
Yeah, I was having a conversation the other day with someone who deals a lot in construction, and they were saying that there's a lot of generational transitions that are happening, right? Where people are retiring or passing away, and so they've got to transition these businesses. And they were kind of surprised, or these founders were kind of surprised, where they would think they're going to sell their business, but then they would look at this and the acquirer would say, you actually don't have any assets here. Your CRM is in your mind. The decision making is flowing through you. You don't have a team. Everything is based off of your own. So what is it that we're really buying here? And so that's always been a really good reminder for me that a business is acquired for their assets and what they're able to build. And so I guess the question for you is like, what sorts of assets should a business or a founder focus on investing in, even if it may end up being not as margin accretive or may slow things down than if they just did it themselves.
Yeah, I think, and correct me if I'm wrong, but I think you're referring to, what could the seller prepare in advance to be able to
Sure.
showcase a solid business in that in term. I would say consistent growth is important, right? Like what is the proof point that the business is successful, is doing well? You should have a good 6, 8 quarters of consistent growth to
Hmm.
begin with. That's definitely a intangible but important. Cleaning up the financials so that ways you can track the cost correctly, track the sales correctly. I think that's another thing that I would say that build that fundamental thing in the business. Document any key SOPs from purchase orders to returns management, because that ways, it's not only in the founder's head. It is a process that is scalable and that somebody can take and do wonders with it, by layering it with other efficiencies. Automating the process where possible, building for integration, keeping the systems modular, transparent, maintaining accurate SKU counts and inventory levels. I've focused on that or stressed on that quite a bit so far. And then the ability to showcase the end-to-end tracking and visibility for a proper customer experience, right? I think these are some things that I would say that if it makes sense for the founder to build upon in a business, before they're presenting it out for being acquired.
Yeah, that's helpful. Um, are those things that, like, I guess those are good things to do when you know that you're going to exit, right? And you're preparing those 6 to 12 months before. Is there anything that you would say that, like, I hear a lot of times that brands will invest in brand, or they say people will buy the brand, and I kind of take a cynical view of like nobody cares about your brand, right? They care about how well you're able to generate money, cash flow, profit, things like that. Of course, this is a supply chain guy, so I'll knock brand a little bit. But what are the actual foundational things that businesses actually want to buy? Right? You mentioned having a repeatable process and showing that there's growth or showing that there's resonance in the market. But when you abstract it away, what is it that people are actually interested in buying?
Yeah, no, that's a good point. So I'd say a differentiated product or a brand, right? That obviously there is interest in bringing on board something that can be the complementary to your existing business, right? Or it could be where you could do ton of cross marketing, or making sure that this business has, as I mentioned earlier, good scalability. Can it grow? Does it have consistent growth? Is this product something which is in demand? Is this product that can be scaled to consumers? Or a service sometimes, right? And is there enough bandwidth or a roadmap for innovating that particular product or brand, right? I think those are very critical because the last thing that most acquirers would look for is that, hey, I want to go get this product and get into a price war with everybody else who's out there. That's not the intent, right? The margins are super thin when it comes to online business unless you have a greater ASP, right? Electronics, jewelry, etc. So I would say the mindset again of the founder is that, hey, what is that product that I have which is a bit innovative, which is in high demand and is going to continue to stay in demand as far as I continue to innovate and improvise it. And last but not the least, is something that is a decent ASP to get me good margins. I think those are important because you are acquiring a business to grow it. And when you mean what you mean by growing it is that you can generate more revenue from it and ultimately more profits from it, right? It makes the acquirer's portfolio more comprehensive at that point.
Yeah. Yeah, that makes sense. And I usually tell people that there's three reasons why, three kind of criteria you have to sell your business. The first one these days is you have to be profitable, right? Like it's a non-starter if you're losing money, because you're either not going to make much or it's just they're not going to get any interest. So you got to be profitable. The second thing, like you're saying, is you've got to have some sort of unique capability, whether that be a product patent, distribution, a factory relationship, a team, a networking, or a marketing aspect. But there's going to be some unique capability that they're acquiring. And the third part is they need to see some sort of meat on the bone, right? There has to be a very obvious win that they want to go through. So I usually throw out kind of the international piece where I tell companies now, don't go international until you have to, like own the U.S. market, because if you are, uh, if you have an attractive a business just in the U.S. and you're pitching an acquirer that is in Europe and Asia, you're able to say, hey, look at all this potential, and they're willing to price that in and pay a higher multiple because they're doing the math that within a year or two they can plug it into their existing distribution network and generate X hundred millions of revenue, and that works out. So that's kind of my framework that I look at. Do you look at something similar? Would you adapt that at all?
Yeah, very much. I think you said it right, and I think from what I shared earlier, I think it all boils down to these three things, right? Hey, do I have a good top line? And as I said, do you have consistent 6 to 8 months of growth that you can showcase? And if you have, which means you have solid growth. Number two, can you do that fine balance of top line and bottom line together? Because at every stage of the business, some companies are only looking for top line so they can burn money easily, but that's not sustainable, right? At certain stage, the company is starting to make some break even and some profit, and at a point is consistently growing in the top line and the bottom line is steady and stable and solid, right? I'd say that latter phase is something that I would look into personally to say, hey, listen, you got to that stage where you proved the business, you have some meat in terms of there is potential to the business on the top line, you maintained a consistent bottom line, and the last thing that I mentioned earlier, you also mentioned that is a product innovation. Do you have that differentiator, right? Whether it's new product development tactics or innovation, doesn't matter what, to continuously keep growing the business versus so a good example would be fidget spinners, right? They did amazingly well, but then they died.
Yeah. Now everybody who wanted one bought one. Yeah.
Right? So that wouldn't be a business I would want to get into just for seasonality perspective or the trend perspective. Um, but yes, if it's sustainable, like hey, if I had a great health and beauty product that's doing amazingly well these days, and it's organic and it makes sense, and the supply chain is not too complex for us to change a lot of systems and processes. Then you know what, definitely love to look at that and see the potential for it.
Yeah, your fidget spinner example is a good one. And one of the things that I have heard is that most D2C brands will launch with a single hero product and they'll be known for the fidget spinner, the X whatever is going on. But then there's always this push to turn that brand into a master brand and to be able to show that they can, if they're selling dog food today, they can also sell dog toys, right? If they're selling tampons, they can also sell lotion or lube or things like that. And so I guess that how important is that? And is it important that the brand has proven out that they can build a master brand before they sell, or is that something that an acquirer would look at and say, you know what, I think there's potential there. I think we can leverage it that way.
I think the former, because again, the reality is that you have the option, right? Do you want to take brands and you want to invest the time and effort in brand optimization and supply chain optimization and start everything from scratch and get it its own potential? Or do you want to take a business that's successful, right? That's giving you the indication that yes, there is potential to take this business and take it to the next level. I'd do that rather, in terms of hey, you have a great business, you prove through your hero SKU, and you have other things that are in development. It is a matter of us coming and helping a optimize, b adding our talent and skill sets, whether it's to help sell and grow the business or to optimize the bottom line. But we do not want to recreate a brand, right?
Right.
Because if we were to do that, why would we acquire? Why wouldn't we do it ourselves with our connections?
Yeah, you're absolutely right. I guess when is it too early for a brand to start working on those sorts of things? I imagine if you're just launching and you haven't proved out your market yet, you probably shouldn't be launching other products. But I guess how do you know if you do have that fit and it's time to expand out?
Yeah, that's a tough one. to be honest, because really revenues are great, but again, if it's a very high ASP item, then you're selling less units and you're generating more sales. Versus, it's a volume game where you are selling a ton of cell phone cases, but the sales and the revenue is small. Even the units you're selling is high. I think when you get to the over $1 million mark, right, in terms of sales and profitability is good 15-20% at the bottom line consistently. Um, could be a one of the variables of the many to say that, hey, listen, I would like to see if I have any buyers out there that I can complement, their existing business and go from there. But when you are under $1 million, and this is purely my opinion. If I were to go in as an individual buyer, I wouldn't want to go into some business which is under $1 million with no consistent margins or under 20%, and trying to make something out of it, because it's easier to just build something similar if it's no differentiator and scale it yourself.
Yeah. I imagine it also has to come into play with what kind of exit you're looking for, right? Obviously, if you are looking to exit for $5 million, that's a different rubric and playbook than if you want to exit for $500 million. And
Correct.
so I guess how do you change your answer based on that? Like if this is a side hobby for me and I'm like, look, I just want to get this going and I want to be able to sell it to Thrasio or whoever, what do I need to do that's there versus, hey, I want to exit to Procter and Gamble in 10 years?
Yeah, I think for the bigger exits, if you will, which are always great. Do you have a differentiator is the biggest portion, right? If you have a differentiator and you've done amazingly well in terms of building that brand, customer retention, customer loyalty, repeat customers, good lifetime value for the customers coming into play, and less churn, right? Where you're not churning your customers or every 2 months or every 6 months, but there's repeat customers, and you've just touched a single, say, example, US. You've not even got into North America, as in Canada, or you've not gone into other countries cross border. um, I would say building that fundamental framework or infrastructure to say, hey, listen, I've proved myself over here and I have a differentiator. I've done something that others have not done it, or I've done it in a way where it's more efficient and effective and able to be scale in the future. I think that's where I would want to recommend companies be, where, hey, even if I were to run the show by myself, I have a great story and a great structure to scale the business and foundation. But some like Procter and Gamble or Unilever comes into play and says, hey, listen, if I were to absorb this company, not only am I able to bring in innovation in my business sooner, faster to accelerate it, or bring in a proper digital transformation into business and go from there. I mean, good examples, if I could go a little bit outside of the just consumer goods industry, is someone like UPS did an amazing job with digital transformation by acquiring companies around it, whether they acquired Rory as a last mile delivery company or Where to Go as a technology platform for third party logistics, or it went into Happy Returns to manage the returns. It created this digital transformation around the customer, to meet the needs of the current state, but they moved fast in it, and that accelerated the efforts, right? So those are good examples of companies that built a technology platform or a product that was the need for today as a differentiator. They moved fast, they built a strong company and a brand, and it got attracted by a large organization to come and say, you can add value to my entire customer portfolio, and I'm going to come and acquire you. So, as an example.
Yeah, no, that's a great example. Yeah, the UPS has just done a fantastic job, kind of imagining what could be, and then going out and getting the pieces together. And it's just it's a great idea. I know we're
Indeed.
coming up on time, so we've got two questions that we always ask folks. The first one is, what's the best example of a moat that you've seen a business build?
Yeah, it's a good one. So I'd say, I'll give an example of just one brand, that was good. They sold seasonal summer products, and they're doing great over there. But they came in and then started to build some consistency across the calendar year by adding complementary items to it, right? That would allow them to stagger launches and partner with vendors in a way that optimized labor and production year around. That created negotiation power for them with partners for the year round, better cash flow and operational leverage. A true mode behavior, in my opinion. Like, you don't think about these creative things that, hey, I got this product and I'm going to sell it, but hey, my product is seasonal, only used in summer. It doesn't have the peak season that others have or whatnot. Can I add more complementary products that will not have too many ebbs and flows, but is a consistent cycle year around? So that was a brand which I felt that was thinking ahead in terms of how do I operationalize my business effectively or efficiently.
That's a good one. A lot of folks will say sell swimsuits in the northern hemisphere and during the summer, and then try to do stuff in the southern hemisphere in the winter.
Right.
That's good. Last thing is, if you had to start today, how would you go about building a business worth buying?
Um, you know, Definitely start with a strong presence on marketplaces where you can generate traffic right away with like Amazon or Walmart marketplaces. That would help gain traffic. Obviously, in parallel, build a D2C or a social commerce arm to prove the brand value and pull traffic from alternate channels. That's on the front end. On the back end, from a logistics perspective, definitely start with a single 3PL centrally, so I'm not having to mirror the inventory initially. But once I've proven the model, then grow it into like a two node plus network to balance inventory, to reduce the time in transit and the transportation cost while enhancing customer experience. Sourcing wise, definitely not only now with the tariff situation, but in general, I'd always advise people to, or I would do it in a way where it's dual sourcing. Say if it's China, I have India as a backup. These days, that's very important. And then at the end of the day, always keep a manufacturer to consumer model ready. Something that I've been helping a lot of companies build too is how do I have SKUs that I can easily ship from my manufacturer's site or a 3PL in Asia to the consumer's hand in 5 to 7 days, outside of the normal FBA, SFP situation where I can offer a 2 day service locally, having the inventory. But that's definitely, I would say, would be some essential things for me to build a strong foundation or a business today.
Love it. It's great advice. I can't believe where the time has gone. I think we could talk for another couple hours. Thank you so much for being on.
Of
If
course.
people want to connect with you, follow you, what's the best way to do that?
Yeah, no, obviously LinkedIn is a great way to connect, or on my business email is Thakkar at m2ctrade.com. Those are definitely good options to reach out to me, and happy to help and add value where I can be helpful.
Awesome. Thank you so much. And thank you for tuning in, and we'll see you on the next one.
Great, Aaron. Thank you.
Thanks for joining me on Build a Business Worth Buying, brought to you by ISBA Consulting. I hope today's conversation gave you real insights into scaling smarter, selling better, and thinking like a strategic operator. If you found value in this episode, make sure to subscribe, leave a review, and share it with someone who's building their own sellable business. Until next time, remember, the real win isn't just building a business, it's building one worth buying.